And the first slide here has my cell phone information on it, as well as my email address. And then I always recommend that excellent website to bookmark or save to your favorites is the one there in front of you, wholesale.springeq.com. And what we do is we offer two products. We have a HELOC, and then we also have a closed-end fixed second. You'll also see it referred to as HELOANs. And you can use both products for either a purchase simul or a refinance simul. You can also use it for a standalone transaction, and there are no restrictions or time limit on the standalone. So a lot of competitors, one, don't offer pure standalone, and secondly, they offer what they call like a deferred standalone. You got to do it within 90 days of closing your first. But the nice thing about our product is you can use it for any client at any time, over any period of time. And the standalone can be a customer that you did business with 5-10 years ago. What you'll see is we are licensed in 39 states and the District of Columbia. There are a few states that we are not in. The closest ones to you in California would be Utah, Wyoming, Idaho, but there are states that we are working on right now, such as New York, Massachusetts, and Utah, but we just haven't gotten there yet. Again, if you want to access our rates, our matrices, our guidelines, any information about Spring EQ, you can go to wholesale.springeq.com and you'll find all the information there. Our HELOC product is an interest-only payment and a 10-year draw period, which I love this product. I've been in this product for many, many years. For the simple fact that it gives the customer financial flexibility. They're able to use the mortgage, the second mortgage, any way they want to. They can pay it down, they can redraw it, they can use it for college educations, they can use it for home improvements, debt consolidations, whatever the customer's dreams are, they can use it for that 10-year period. After that point in time, it does go into a 20-year reamortization. And the HELOC is always an adjustable rate. So during the 20-year reamortization, they will could or see interest rate adjustments. The total period of time is going to end up being 30 years. 18% lifetime cap. It does have an annual fee on it of $99. And when we underwrite the file, we underwrite it based upon the customer start rate +2, and it's underwritten as a fully 30-year amortized loan for the full line amount, meaning that if the line amount is for $200,000 but the customer's initial draw is only $100,000, it will be underwritten at the $200,000 dollar amount. Max debt ratio on all of our products is 43%. On the HELOC here, we can offer it on an SFR, a condo, a PUD, a townhouse, no investment properties, and in one-unit properties with a minimum draw of $50,000. So when they do at the time of the loan, their initial draw has to be $50,000. You do not want them to repay that $50,000 because it can lead into compensation issues with regards to how your compensation plan works. Maximum loan is $500,000 with a combined first, second combo or limit of $2 million. And on the HELOC, we can use your appraisal for up to 4 months. And that's important because when we get over to the closed-end fixed, we can actually use your appraisal up to 12 months. Our closed-end fixed product, they can have terms of 10, 15, 20 years. They can also have terms of 25 or 30 years. It's a fully amortized loan. The closed-end fixed is basically similar to your 30-year fixed mortgage. It's a fixed term, fixed amount, fixed payment. They cannot draw on it. Once they draw, and if they pay it down or accelerate it, they can't redraw and reuse it again like a HELOC. So that's why I always like the HELOC, because it does give you that financial flexibility. The customer can pay an interest-only payment during those 10 years, or they can treat it as a fully amortized loan and pay extra if they want. There is a difference on the HELOAN in that we will allow 1 to 2 units. We also allow investment properties up to 70% CLTVs, and then all the other SFRs, condos, PUDs, townhomes. Same max minimum, or same max combined loan amounts. The minimum loan amount on the HELOAN is going to be $25,000, which is obviously different than the $50,000 on the HELOC. As I mentioned earlier, we can use your prior appraisal up to 12 months. And I should state, I didn't have it on the previous slide, but we will go down to 640 FICO scores. On the HELOC, we'll go 640 at 70% loan to value. On the closed-end fixed product here, we'll go 640 at a 80% loan to value. Also on both products, we will go up to 97.5% CLTV on FICO scores of 740 or greater. There will be some rate adjustments based on line amounts or the loan amount. There will also be some adjustments for a couple states. And then if you do business in Tennessee on this product, the maximum term is 15 years. The competitive advantage for Spring EQ is that we offer lower FICO scores at 70 and 80% loan to value than anyone else. We also offer higher CLTVs on 740 FICOs. I don't know of anybody else in the industry that's going past 90% CLTVs. We will go up to 97.5 with the with both products. And again, with both products, typically what you see with other lenders is they might offer a HELOC and that's it. We have both products. So what's nice about that is if you have a customer that doesn't mind the interest only or the adjustable rate part of a HELOC and they want that financial flexibility, you can offer them that product. If for some reason you have another client that just likes that consistency and constant payment term and rate, you can offer them the closed-end fixed, or as you've seen in the slide here, it's called a HELOAN. It also is a great, both products are great for breaking up jumbos. If you want to move customers out of the jumbo market and get them into the conforming or high balance market, it's a great move for that. You can go an 80-15-5, you can go whatever you want, 75-25. You can break it up however you want to, but in the jumbo market, you normally have to deal with a lot of reserves, or you may have some reserve issues or some conditions or STIP issues that come up just before clear to close or even after. So what's nice is you can break up the jumbo and get away from that because Spring EQ never requires any reserves whatsoever. Very commonly, we do not verify assets. We just simply take what you have stated on your 1003, 1008. So it's a nice way to break up jumbos and be very competitive in the market and even get some better pricing. This last weekend, I had somebody tell me that jumbo pricing was anywhere from 75 to 100 bips higher than conventional pricing, but those are some things you can do too. If you're in a condo situation, we never require any condo certs, condo questionnaires. The only thing we need is the master policy for the homeowner's insurance. And then obviously the customer has to carry an HO6. But it's nice for your condo market too. If you want to lower your first LTV, get it down to a point where you don't have to worry about a condo search yourself. We do not use your credit bureau. We only use ours. We pull one credit bureau, and that's the Experian FICO Score Model 8. And the FICO Score Model 8 tends to be a little bit more robust and a little bit better scoring system than what you'll see on the first mortgage side. The first mortgage side, your model scores are typically a 2, 4, and 5. And so there's no mid scores. You don't have to worry about the what you're dealing with on a TransUnion or Equifax. We only have the Experian. As I mentioned earlier, no cash reserves. We also allow up to 10 finance properties where a lot of other organizations go with 3 or 4. I'm going to show you an example here of some 97% CLTVs. As I mentioned earlier, you can do the conforming 548. And if you were going to go at 97% on a 5 and keeping the conventional market, your purchasing power would be $560,000, and you would have mortgage insurance on the entire conventional 548. Otherwise, what you could do is you could stick with a 548 250, look at a 17% second mortgage with Spring EQ, And so now your new purchasing power is boosted to 685, and you have two loans at 97% CLTV, and you basically have an 80-17 with the borrower only having to put down a 3% down payment. The other thing is on the conventional side, you now have eliminated mortgage insurance. So that's just an example of, when you're thinking about a purchase, being able to boost somebody's purchase price ability, moving them from a 560 up to 685, getting them into a little different house, maybe a nicer house, maybe a nicer neighborhood. And if your market's anything like ours here in Denver, it's a bidding war. So customers are having to bid on some properties and pay premiums over the asking price. Well, one way to think about increasing your production is, as I mentioned earlier, the simultaneous purchase and refinances. It gives you a little bit more competitive advantage over somebody else. You eliminate the mortgage insurance, you eliminate reserves, you allow the person to buy a little bit bigger house. On the standalones, you guys have been offering great rates on first mortgages for many years now. And so a lot of times the customers are not in, whatever you put them into in the last 2 or 3 years, 2.5%, 3% mortgages, they're not going to want to give those up for 30 years. So now you have the ability to work with a customer on a true standalone. They come back, they want more money out of the house, they want to use that equity. You can now offer them some opportunities, maybe a down payment recapture. You can refinance existing second mortgages. You can do debt consolidations, home improvements. They could use the equity in the house to buy a second home up in the mountains or out on the beaches or wherever they want to go. And even an opportunity to buy a purchase investment property. The thing that I've always said for many years in this market is, why would you want to refer your clients to somebody else, another bank or credit union, when you have had that rapport and that customer relationship with them for so many years? Why would you want to refer them out and take the chance, and now a bank or a credit union or someone else starts to steal your clients and they completely forget about you and don't come back to you? So this standalone allows you to be an all-encompassing mortgage service organization to all your customers, all your individuals, and not have to refer them out. You also have the opportunity for compensation. And when you signed up for to do business with Spring EQ, it looks like your compensation was 1.75. And this next slide is going to show you a little bit about that compensation. The illustration is obviously at the max 2%, but on a HELOC, your compensation is borrower paid, meaning it comes out of the customer's draw. So if they take out a $100,000 HELOC at 175, you'd be paid $1,750 on that $100,000 draw. And it's all borrower paid at that point in time. On the closed-end fixed second, there's two options. You can go borrower paid or you can go lender paid. If it's borrower paid, same thing, it comes out of the loan amount. If it's lender paid, on our pricing sheet in the premium pricing, down on the bottom right-hand corner, you will see a BIPS addition. And so that's what you would do, is you would add the additional BIPS to the starting rate, and it would be lender paid then. And the same thing, we always send a check right to you guys. If it's borrower paid or lender paid, we send a check right to you. There is a limitation. Total max comp is $10,000, but you would not be hitting those because of your compensation at 175, and also the fact that the maximum loan amount is $500,000. There are going to be some overlays, and the overlays are they're not I consider them more minor. I don't consider them serious. If a person is departing a residence and moving into another property, and they're going to turn their departing residence into a rental, we do require an appraisal, and it has to verify 25% equity position in that. And then we also require the executed leases, first month's rent, security deposits, things of that sort. With regards to rental ratings, we do require VORs from a management company. If it's a private landlord or a private individual, we're looking for a copy of the lease, 12 months canceled checks. And if they're living rent-free, say living with a parent, we simply require a letter from the relative acknowledging that, signed and dated. If a person is in a decreasing income situation and their income has decreased year over year by more than 20%, we're not going to allow the decreasing income. We're not going to take a look at averages. We're just going to use the lower of the two. And then overtime and bonuses will not also be used in that situation. We never allow a non-occupant co-borrower. So if a parent is going to be a non-occupant co-borrower with a son or daughter, we don't allow that. We also do not allow POAs on any of our transactions. So if you had husband and wife, two different states, we require both of them to sign the documents, no POAs. And then the last one is on self-employed borrowers. We must have 2019 and 2020 complete tax returns. And I'm going to jump over to the next slide and just show you how the policy reads. We have to have 2019, 2020 complete tax returns, business, personal, filed. The 2020 tax returns can be verified by transcript or evidence of liability being paid, or if a refund was coming back, we could also do that. In addition to those 2 years tax returns, we also want to see 2021 either audited P&Ls or unaudited P&Ls. If we go with the latter here, the unaudited P&Ls, we will also require 3 months bank statements, and those bank statements must be business bank statements, cannot be personal, which the question always comes up, well, if the borrower is a Schedule C borrower, typically a lot of times Schedule C clients will have all their business money running through a personal bank account rather than having separated accounts. We will not allow the personal bank accounts that do need to be business. One thing that's really nice about Spring EQ is you always have access to our portal, so you can register loans there. You can pull the credit. You'll have a real-time loan status. So if you wake up at 3 in the morning and you decide you want to see what's going on with conditions and STIPs, you can pull it up. You can take a look at it, see what's going on. You will always have contact with customer advocates and loan officers and our underwriters. So you can talk directly with an underwriter and work out if there's any issues with, ratios or CLTVs, income worksheets, liability, things of those sort. You can always view the credit report. In fact, you can pull the credit report. When you register the loan, you can pull the credit report. You can lock the loan. You can see the lock confirmation. You can submit the loan. It's a very user-friendly, hands-on, 24/7 access to your files. You can print and save any of the early disclosures, the lock agreements, the conditions, the closing disclosures, and even the final loan documents. So the portal is very user-friendly, and we won't have time to go into it today, but I'll just show you a brief screen of it here. This section up here is how you can log into the portal directly, or you can also go into our wholesale.springeq website, go over to partner login and go to step 2 and just log in through that. Here's a breakdown of our fees. A lot of times there's a question about PIWs. We don't accept PIWs. However, we have in our policies any loan amounts less than $175,000 or $250,000, depending on the loan product. We can do an ABM or a drive-by, and we can do it very inexpensively and get it done a lot faster than a full appraisal. So if you do come up with a PIW, just keep in mind that we can probably more times than not, because of the loan amount, use the an ABM or a drive-by. And then lastly, here's our website again. You can access our portal again through the website, or you can go into the portal directly through that other document. And if you are in the portal, all you have to do is click on guidelines or any of these icons, and it will also take you back to our website so that you can access any forms, any compensation issues, any questions that you have about rates, guidelines, matrices, things of that sort. And I'll just, at this point in time, open it up for questions.
All right. Well, I think this is great. So this is definitely a good addition, and opens up, some scenarios, I think, for some of the borrowers that we're dealing with. For everybody on the webinar, the information is in the back office too, in the MLO portal. So Spring EQ is in there, links over to their website, and Cal's contact is right there on that page as well. So for their first submission, should they probably call you to get a little walkthrough on the portal?
Absolutely. You can contact me by email or phone, and then what I'll do is I'll call you back, and I'll be on the phone with you and walk you through your first submission. The best way to start your first submission is to have your all your information in a 3.4 IRLA. Once you in the 3.4 IRLA will allow you to download all your information into a very short application, and then there's a lot fewer boxes we have to fill in or adjust or complete. And so that's it. I'm sure you're already converted over to the 3.4.
Mm-hmm.
Okay.
Yes. Cool. Well, I'm sure we'll be in touch, or some of the other LOs as well. Like I said, we recorded this so we can send it out to them, because I think this is definitely a good option for a lot of borrowers out there, especially these days when everybody's trying to stretch, to get into a home and stretch their buying power a little bit.
Absolutely. Absolutely. If you have any questions or emails or anything at all, do not hesitate to reach out to me. I'm always available to get back to you and answer those questions for you. I think, Travis, you had one about LPC, and I think I covered it for you in that slide.
Yeah.
Okay.
Yep. So,
all right.
Well, I really appreciate you coming on and educating us on this. I'm excited to have you guys on board for sure.
Well,
yeah, thank you for the great info.
I'm sorry?
Thank you for the great info.
Oh, you're very welcome. Thank you for your time and allowing me to come on and be with your team today. I really appreciate it.
Sounds good.
All right. You have a great day.
You too.
All right. Thank you.
Talk to you soon.
All right. Bye.